I appreciate you joining us here today. And I want to turn it over to Jason Myers, CEO of NGen, to get us started. Jason?
Thanks a lot, Sean. That's a pretty daunting task that you've outlined for both Peter and I hope we live up to it. Really glad that everybody has been able to join us yet again for another round of not only economic foresight, but I think insight from the best economist in Canada, and a great friend of ours and of NGen. But before I introduce Peter, I'd like to thank Salesforce, who is our major sponsor for today, and of course a great supporter of manufacturing industry across Canada. You know, with all the uncertainty, the challenges that are facing manufacturing today, a company like Salesforce really helps to not only modernize commercial operations and of course being able to reduce revenue leakage, transforming the entire service experience for manufacturers, help to channel or strengthen channel partnerships, and really easing the way that business is done today. Salesforce's platform is built for agility, and it really allows manufacturers to pivot into those new business models, to prove out new business models, which is a real asset in today's world of uncertainty. And I think we'll be talking about that later on today. So visit salesforce.com to learn more. Thank you again, Salesforce, not only for support for this particular webinar, but all of the sponsorship and all of the support you provided to NGen and to the advanced manufacturing community as a whole. You know, it's always a pleasure for me to be able to introduce Peter Hall. Peter's a former economist for EDC. He is now running his own consulting firm, and Peter, I'll let you speak about how that's keeping you busy these days, and I hope not out of trouble, but at least busy here. Peter is a great friend. We've been working together for many years, and as I say, the insights that he can provide in terms of not only what's going on here in Canada, but around the world and the global economy is really crucial today for our advanced manufacturing sector. Now, Peter joined us in 2020 to do a similar type of economic outlook. And at that time, of course, we were in the midst of, or the pandemic had just struck, a lot of uncertainty around that. There was a ship caught in the Suez Canal. Here, it looked like supply chains were really going to be under stress. That just seems like ages ago. And the supply chain problems that we've been facing have become more and more acute over the past 2 to 3 years. Not just COVID, of course, and not just the Suez Canal and bottlenecks in logistics, but the entire shipping industry around the world, shortages of critical parts, and now growing geopolitical tensions, the impact of the war in Ukraine, all of that's affecting the manufacturing sector in Canada and around the world. And then, of course, the impact of growing inflation, which Peter actually warned us about a couple of years ago. Said, look, there's a lot of money out there. People are saving money. There's a lot of cash out there, but unless supply is able to keep up with that demand, we're going to see inflation, and that's exactly what's happening right now. So great to have Peter join us. This sets the stage for a discussion not only about what's happening right now in manufacturing and global supply chains, but about some of the bigger transformations that are happening in the business of manufacturing around the world. Clearly, supply chain restructuring, supply chain resilience is one of them, but it's only one of 3 major transformations. The other, of course, is the potential and some of the challenges, the opportunities in the field of advanced technology. That's clearly a focus of ours, but it's one of many challenges and one of many transformations that are affecting manufacturing. The other challenge and trend that is going to have a huge impact, of course, is the transition to a lower carbon economy. That's something that that manufacturers also have to be aware of, and it's impacting in many cases through simple things, or not maybe so simple things, costly things like insurance premiums today. And the fourth area, of course, is labor shortages, skill shortages, acute problem, not only in Canada, not only for manufacturers, not only for the tech sector in Canada, but we're seeing these labor shortages around the world, and companies having to respond to that as well. So some big things going on, and it's time to pass it over to Peter and ask him to put some of this into context. So over to you, Peter, and thanks again for joining us.
Thank you so much, Jay, for those very kind words. I'm not sure all of those words were deserved, but very appreciated. I'm an admirer of the work that NGen is doing. I believe it's on the forefront of really where Canadian business is developing at the moment. We're in a small open economy, and one of the key tenets really of NGen, and I hope I'm not getting this wrong, Jay, but is to create ecosystems, or to bring industry together, to create those economies of scale that often don't exist inside of a large economy. I've actually, through no efforts of my own, been pulled into these ecosystem exercises in more than one industry. And it's very interesting to see just how the conversation is going right now. So Jay, I wish you all the very best in the work that you are doing to spearhead this inside of Canada. I believe it's going to make all the difference as to how Canada goes forward. And of course, Salesforce, thank you for putting all of this together and for the opportunity to talk today. A couple of words on what it is that I'm doing. I've already said a couple of words about what I'm doing, but really in my final years at EDC, I found myself doing a lot more bespoke advice to key customers. And this was something that thrilled me. And it was amazing just to see some of the thought transformations that were going on around the executive tables and boardrooms of the country. And so I decided, not long ago, I guess, that it might not be a bad idea to get out and do that full time. So that's what Econosphere is really all about. I'm a numbers guy. Jason knows that I love to play with the numbers, play with the models, keep myself current on what it is that's going on in the economy. And of course, I'm leveraging that to assist primarily Canadian businesses to go forward and to know where those growth sources are. And that's really what our talk is going to be about today, because as Jason has really very aptly said, and here's my deck, you should see that on your screens right now, great big purple mass there, that's my brand color. There is a tremendous amount of chaos in the world economy, and the world is being influenced in terms of its thinking. It's asking itself, with all the chaos that we are surrounded with a global financial crisis that we never really recovered from, with all the mayhem of that, that interim period there, then, just as we might have been about to be recovering, along comes the pandemic, takes our feet out from underneath us, lots of mismessaging around all of that. And the question that many have been asking, and prominent pundits have actually been opining on this, is forecasting actually a lost art? Now, a quick question over to you, Jay. Are you hearing this as well? I'm appealing to sort of the writings that are being done by Stephen Poloz and Mark Carney and Klaus Schwab, actually, and others like them, people that people are actually really listening to, talking about the models being broken, talking about it being very, very difficult to wrap ourselves around this paradigm. Jay, a couple of thoughts on that. Is that what you're hearing, not only from, pundits like us, but from business in general?
Yeah, very much. I think models are being broken in many areas. These big challenges on the innovation side are also breaking lots of models about how business has to think about growth as well. I always am reminded when we took our microeconomic courses, and I think this is still what is taught in microeconomics, that you know the microeconomy works on the idea that there's number one perfect information. Well, the last 3 years have shown that not only is there not perfect information, but it's really difficult to kind of forecast what we don't know there. So that's one thing that's really changing some of the models, and I think the way economists need to think about the economy. The second thing is, of course, we're taught that in a perfect market, companies come into the market for particular products until profits are driven to zero. That's the way the economists look at the micro economy and approach market development. Of course, that's the basis for how businesses operate, because nobody wants to be in that situation. That's the beginning of business strategy. How do I avoid that? How do I make money? Nobody wants to see their profits driven to zero. So that too is becoming much more important. And then the third part of this is just the impact of technology and how a connected economy works, which is very much different than how individual companies operate. And as you said, what is important for competitiveness is not only how supply chains compete, but how value chains compete today.
Mm-hmm.
So no company can do this on their own. So lots of stuff going on, and I think one of the big issues that I'm going to ask you about a little bit later is, there is an assumption that people in central banks actually know what they're doing, and it's based on monetary assumptions and monetary theory that's been around for quite a long time. And is that the right type of assumption that we need to operate on when a lot of these price increases are coming from international factors that are beyond the reach of any central bank?
Well, thanks for the heads up on that question. That's not an easy one.
Simple question.
Well, exactly. And you threatened to pit me against my former boss, Mr. Polas, but I'm good for that. He knows that inside the tent, I've disagreed with him a number of times. So we'll see where this goes today. Well, those are the kinds of observations that we're hearing about all the time. But the interesting thing, Jay, is this doesn't take regular people operating in a business off the hook for being responsible for a forecast. I mean, that's the crazy thing, is that if the professionals are finding it difficult to actually do a forecast, can you imagine an entry-level buyer in a firm who's trying to actually get the inputs, the raw inputs for the firm, and they're sort of handed on first day, okay, you got to get some of this and some of that and some of the other things, and here are the contact numbers, and you better negotiate really well. And it's like, well, I don't know what prices are going to be 2 months, 3 months down the road. Do I lock myself in? Do I go with a spot price now, and so forth? And all of a sudden, all of that education that they brought into the job with them hangs on a forecast. And so when professionals are having a hard time doing a forecast, I don't know how it is possible to actually get your mind around doing a forecast inside a business, but we still have to do it because that's where we make the money. Isn't that right? We've got to know what's actually coming down. And so all of this chaos talk that is going around is very disturbing. Now, what I think it's important to distinguish between is the things that are different and the things that aren't. And that's where we actually can form a basis of doing our forecast. So before I actually get into the outlook, what I wanted to do is to share a couple of thoughts on how globalization has actually changed things and how it has not changed. And a very simple diagram here is going to take us sort of back to our school days, but I'll try to make this as light as possible. The economic cycle. Now, Jay, you remember when we were in our entry-level macro classes, and one of the first things that they talk about is the 4 phases of the business cycle. And those 4 phases are still there. What are those 4 phases? Well, there's the peak of the cycle, there's the recession phase of the cycle, there's the recovery phase of the cycle, and then there's the growth phase of the cycle. Okay, so 3 of those are growth phases. The peak, the recovery, and the growth are all about growth inside of the economy. Now, this isn't to scale because I did a mathematical sine wave here. And so it's sort of messing me up a bit because it's taking my phases and it's making it look like recession is the biggest thing that happens in a business cycle. It's actually the smallest thing. A bad recession is about 6 quarters. That's a year and a half. And, if there's such a thing as a good recession, it's a 2-quarter recession that's pretty shallow. That's the technical definition of a recession, only 2 quarters. And so you can see there's a bit of an accordion there that happens. 1990 and 91, that was a long one. That was a 6-quarter recession. Sorry, that was a 4-quarter recession. You can get up to 6-quarter recessions. Those are particularly bad ones. The Great Depression and so forth, multiple quarters back to back where you see really big ones. But for all intents and purposes, they don't last very long. And you can have, the other phases of the cycle take about 80% of the entire cycle. That's the way that you need to think about it. Growth is about 80% of this, and the recession is about 20% of this, rough rule of thumb. All righty. So what does that then mean for us? Well, we normally see this happen over a 10-year period of time. So roughly every 10 years, you'll see a wiggle in the economy, either a big one or a little one. And that's something that you can regularly or generally depend on. Now, back in the Great Depression, the economists at the time were frustrated with the fact that there were ups and downs in the economy. It was looked at as being a really a bad thing, I guess, about the capitalist system. And it's sort of like what Winston Churchill said about politics. Capitalism is about the worst economic system ever invented by man, except for all those other ones, of course, that we try from time to time. So it's a really poor system, but it's been the best one, really, in terms of efficient outcomes that we can see. So cycles are something that we sort of have to live with. All right, now along comes globalization. And what happens to the business cycle? Well, nothing. It's exactly the same as it was before. We see the same 4 phases of the cycle. But what I believe, and this is not something that is in the literature yet, this is something we are still debating as economists. So I warn you with that. But I believe that what we've done is we've taken a 10-year cycle and we've stretched it into 20 years. Now, how has that actually come about? Why the stretch? Well, technology has actually enabled us to grow for longer. Why is that? Well, technology enables us to do a number of different things. It enables us to mechanize more processes. So we don't need as much labor per unit of output as we used to. And so we can get more out of the population. There's more productivity there. Productivity increases actually lengthen the amount of cycle that we can get. Now, we've had productivity increases over time that haven't had a huge impact on the length of the business cycle in the past, but I believe that the exponential increase in technology that we're seeing right now is something that's actually done that for us. Number 2, and it's related to technology, communication. We can now communicate on a 24/7 basis all over the planet. So wherever the sun is up, you can actually be doing business. You can just move around to where the sun happens to be. And there we are. Now, the sun's not the one that's moving. Okay, I didn't get my astrophysics wrong there, but communication is the point here. And that is, you can run a factory just about anywhere you want in the world, full 24/7 monitoring of what it is that you're doing through communication technology. Logistics have been vastly improved by all of this as well. And so we can time the movements around the world so we don't have to have extraordinary inventory accumulations all over the place. We've been able to mitigate that. And of course, the efficiencies there have actually stretched out the business cycle as well. Labor constraints have actually pushed us to globalize and to use the labor inside of other countries. And so that has stretched out the business cycle. Why? Well, the inclusion of these countries into the global continuum has actually taken countries that are well behind the technological curve and given them a great deal of growth runway. They can outperform the rest of the world for long periods of time. And of course, this actually adds to global growth and stretches the cycle out as well. And of course, the readiness of emerging markets for all the free trade agreements and the openness and the World Trade Organization advances and so forth, the readiness for that, particularly of China, but not just China, everybody else getting onto the bandwagon as well, well, that has stretched the cycle out as well. You might say, well, I don't care. I just give me growth. I don't need to know all of this stuff, Peter. Why did you spend so much time and why are you so passionate about all of this? Well, strategic decisions that you make, policy decisions that government levels make are all contingent on our understanding of this thing. So when the global financial crisis comes along and people go, wow, why was that so punishing? Well, it's like we grew for 16 years. We normally grow for 8. And so what happens in a stretched out cycle is you get exaggerated everything. You get longer longs, you get higher highs, you get more dramatic corrections and deep corrections in the economy. And then it takes longer to actually recover from that. Why is that? Well, you had a bigger bubble. So you got to get rid of that bubble. Well, all of these dynamics are not the kinds of things that we have factored into our increasingly impatience impaired brains in a high-tech society like our own. Okay. You know, I've got this theory about information. The more information that is generated out there, and we've got an exponential increase in the amount of information that's out there, the less our brains can actually cope with further out history, you know, further back history. We're focused so much on the deluge of information that we're trying to pack into our heads that has just come out that it's very, very easy to forget about things that are 2 or 3 years old now. That's ancient history to us in an operation like that. Well, if you've got a recovery period that takes 5 or 6 years to occur, that feels like new normal to a lot of people. If you've got a very long bubble period of time, and the last bubble was about 5 to 7 years long, people start saying, well, this is sort of like the normal paradigm right now. You know, I'm not going to expect a recession. I think this, you know, we can probably just keep this thing going forever. And anytime somebody, whether it's a professional economist or anybody else, says to you, it's different this time, boy, get out your warning lights right there, because that's almost the moment when things are going to start to show that they're just like they were before. So what's different about this time? The cycle has been stretched out. Everything's exaggerated. What's the same? The phases of the cycle still happen. And so we need to get our minds very much around how it is that we accommodate these exaggerated movements inside of the cycle. And if you're making decisions based on that, well, you're much better off, I believe, than anybody else. So this takes us to our current situation here. All right. So we had a big recession back in 2008, 2009. You could see from this series here that retail sales were punished, and punished bad. And they went down, and they took an awful long time to revive, to get back to the previous level. Well, the pandemic came along. Let's fast forward over here, and you see this enormous V downward. And then we took off again, and we've gone nuts. You know, look at the end of this. Now, why do I pick on retail sales? Retail sales are important because they are about 60% of economic activity in the average economy. That's the same for Canada. The consumer is 60% of everything that goes on in the economy. So if this thing is going well, you can pretty much conclude that you've got a strong economy. All right, let's not talk about the strong economy yet. Let's talk about this recovery. Now, many were saying, oh man, it's going to take a long, long time to recover from this whole thing. Well, let's just zap out that period there that we see. And you can see that we dropped for 2 months. And in just 2 months, we were back to above previous levels. So this was a V-shaped recovery if ever there was one. Now, is that what you were told was going to happen? Absolutely not. Jay, you remember, you know, many were out there saying, oh, this is going to be just like the global financial crisis. You know, we're going to go down. We're going to be going down we're going to be down for a long time. This is not a chasm we're going to get out of easily. And we were out there saying, hold on, like we did not have the global bubble situation preceding this downturn in the economy that we had in the global financial crisis time. We had 5 to 7 years worth of excess that we needed to get rid of. You know, big recession, big chasm. This time around, pent up demand. We actually had the opposite that led into this whole thing. So we were out there right from the start saying, hold on, this is a policy-induced recession. And so when policy allows us to actually go back out there and operate normally, I mean, even we didn't think it was going to be a mere 2 months and we would be back above previous operating levels. That was lightning fast, but we got the spirit of that right. And we said, hold on to your hats, businesses everywhere. Don't lay people off. You know, don't go crazy on this. And if you do have to lay people off for cash flow purposes, just make sure that you're staying in contact with them because you're going to need them back real fast. hang on to the inventory that you need. Make sure that you have capacity. Don't sell off your factories. Don't sell off your equipment. In fact, if somebody else is doing that, buy it. And they're looking at me and saying, are you nuts? We're in cash conservation mode. The economy has just taken this enormous hit. And I said, I know this pencil pushing economist is asking you to do something that nobody else is asking you to do. You're going to love me if you take my advice on this. But everybody else in their crush to actually accommodate this fast return of demand, prices are going to be shooting up all over the place. And central banks are quickly going to get behind the curve. And so Jay said, Peter and his team actually called this. We did. We actually saw that this was going to happen. And that is what's occurring right now. Okay, all this retrospective stuff is no good for us because it's already happening, right? Well, if we're right and what led us to these conclusions is true, then there is still something to know about the future inside of the paradigm that we're looking at. Okay, let's just keep going here. We also see a V-shaped recovery in the unemployment rate in the United States. And this is an inverted unemployment rate. Okay, so I've negativized it all. So it's upside down, but I just wanted there to still be a V, just like that retail sales V. And by the way, there was a retail sales V in the United States as well. And for something like unemployment to come back this quickly is really, really a challenge normally. This is a lagging indicator of economic activity. It usually sits behind everything else, and it's not that responsive. Well, you can see that in terms of the inflation barrier to economy, we call that NAIRU, the non-accelerating inflation rate of unemployment. If you go below this, in this case, it's above it here because I've inverted it, you're in trouble. And your wage costs are going to start to rise. Now, you see that prior to the pandemic, we were already in a searing hot US market, and it's very quickly come back and it's done the same thing as well. Now, we're dealing with the same kind of thing in Canada here. Our NAIRU is a bit higher than in the United States. We were only just there at the end of the last, or not the end of the last cycle, but pre-pandemic. Get my tongue sorted out here. We came back and we actually went into the danger zone. Now, this down blip that you see at the end, or it's an uptick in the unemployment rate, actually, that's an end of summer statistical quirk thing. We just didn't get the return to school right inside of the seasonal factors. And so I don't think that that's something that's going to persist. And StatCan seems to agree with me there. They wouldn't say it the same way, but effectively it's the same thing. And so we've got a searing hot labor market here as well. And that's another thing that we said was going to happen. Hang on to your labor, love them, because if you leave them, they're not going to be too keen about coming back to the people that ditched them. And so here we are with a tight situation there. Again, that speaks to the kind of cycle that we have right now and the intensity of demand that we see in the economy. So let's spend some time talking a bit about the inflation issue that we have right now. Let's ask ourselves the question, why inflation? Like if we had enough capacity in the economy prior to the pandemic that was not kicking off inflation pressures, and that's exactly where we were, the economy was hot, but we didn't have inflation pressures, then why, when we came back with the same capacity still existing in the economy, why do we have inflation? Well, I think number one is we simply did not expect it. I'm going to have to, pick on some people here, and I'm hoping that they can forgive me for this. None of them are sitting around the table here, but a very, very prominent book came out when the pandemic hit, and it was called The Great Reset, and it was published by Klaus Schwab, the head of the World Economic Forum. And it was a book with some incredible because they were huge and revolutionary projections of what was going to happen and the remedies that were actually needed. Well, I believe this was highly influential in people's thinking. Well, some of the things that were said in that as presuppositions to the policies that would actually follow are on the screen here. It's hard to imagine how inflation could pick up anytime soon. Well, if you're going to put a policy into place anytime soon, is not just in 2 weeks. You're talking about a near-term horizon at the very least, and perhaps the medium term, 5 years out there. Okay, so no inflation anytime soon. Well, that was sort of a miss. How about this one? The unemployment situation is bound to deteriorate further. And this is when we were going to double-digit unemployment rates. It's bound to deteriorate further. It cannot improve significantly. Well, the numbers that I showed you just proved that to have been horribly off what actually happened. Now, these are forecasts, right? Okay. Every forecaster is circumspect about picking on other forecasters, but this is why we are dealing with a situation where we are wondering if the models are actually broken. What does it say here? It will constrain wages for years and put strong downward pressure on inflation for the same period of time, I would assume. And that didn't happen either. Strong consumer demand is unlikely. Well, the retail sales figures that I showed you, which we could replicate for the United States and for Western Europe, proved that to be way off the mark. The capitalist economy that is being derided by many right now actually showed itself to be remarkably resilient in face of a recession that was caused by policymakers. And it was because of a misread of where the economy actually was at the time. Well, no wonder we've got inflation right now. We were so conditioned to believe that everything was going to be soft for a long period of time that in an effort to conserve cash, we made permanent decisions that disabled our ability, that's overstating things too much, but to actually come back, to jump back onto our feet again, and to do the thing that we were doing just a couple of months prior. Okay, so the inflation actually sets in. What are some other reasons? Not expected is just the first one. Pre-pandemic pent-up demand. Well, what do I mean by this? Well, let's go to a leading indicator of economic activity in the leading economy on the planet, the United States. Now, here is my characterization of the US housing market. And, it's not a great stretch to actually put this one together, because you can see that around the orange line of demographic requirements in housing, demographic requirements are broadly agreed by many institutions in the United States to be somewhere around 1.4 million units annually. And demographics don't change very much. They've all been determined pretty much 20 years ago, when babies were being born, and, they get older and older, and eventually they need a house, they form a household, and then they need a housing start. And then there's some immigration that comes in, people die, people are born, and so forth. That's the demographic dynamic, but it doesn't change very much, right, Jay? We know demographic economics. It's like they change at a glacial pace. But why do you then have a housing market that is so volatile? Well, housing is very related to the welfare of the economy. And if things are going well, people say, well, why not have a second house or a third house or what have you? And then the speculators get involved in that and so forth, and it magnifies things. And of course, housing is something that's very visible to most people. So prior to the global financial crisis, we all know how much of a bender the US housing market was on. The reason it dropped by 75% and stayed there for 2.5 years was the extent of the bubble that was actually there. And it took an awfully long time for people to feel confident enough to start building more houses in the US. Well, somewhere around 2012, that shaded line that you see in the back there, the enormous bubble went down to zero. But this market took so long to recover that a deficit started to occur. And folks, that deficit is huge. It's more than a year's worth of supply of deficit, of need of housing in the US economy. And so the fact that it's gone above that housing starts, the dark purple line have gone above the orange line, does not indicate a bubble. They're actually trying to get rid of an anti-bubble here. So they can stay up there for a long period of time. And here we are, with US housing starts at 1.8 million units for a number of years. And we only just wear down and balance, we wear down this deficit and balance the US housing market. Folks, this is very sustainable inside of the US market. And this, for me, is a perfect illustration of pent-up demand in the #1 economy in the world. That's why the economy came back. Now, I could do exactly the same for Western Europe. And folks, add that up, we get 45% of global GDP. We were not on the verge of a recession. We caused a recession to happen when there was still pent-up demand. There was still lots of growth runway in the global economy. Now, many economists will disagree with me on this, but this is probably the best news that you're going to hear in this entire presentation. And what I'm saying is global growth has actually got a long runway. Now, there is a twist, and I'll get around to the Canada situation in a bit, but it's important to understand that we had pre-pandemic pent-up demand, and that's still with us. Now, we have mid-pandemic pent-up demand as well. You might say, well, isn't pre-pandemic pent-up demand enough? Well, maybe it is enough, but this is another bonus. Now, what do I mean by all of this? Well, folks, when output shut down, most people actually still hung onto their jobs and they still got fully paid. That was part of the plan behind all of this. And those who didn't actually got generous subsidies, but most people still hung onto their jobs. Well, what happens when your income stays the same, but your ability to actually spend it gets compromised by shutdowns? Well, that money piles up inside of somewhere. And you would think, okay, the savvy person would actually invest this. Well, I'm going to choose one of the most boring series that exists in all of the data world to show you that a remarkable change actually happened. Now, what is this boring series? Well, it's the amount of money we keep in our checking accounts. Like, why would you keep any money? Why would you keep a nickel in a checking account? Well, it's for cash flow purposes because you're not getting a return on that. The return is almost negative when you account for service charges on that account. And so, your interest rate is like something really, really meager, and more than that gets taken away by service charges. So you really don't want a lot of money piling up inside of your checking account, except the pandemic comes along and this happens. Something that's just so predictable over time, you could set your watch to it, all of a sudden took off. Now, to illustrate just how dramatic this is, by the time we get to the end of the series, this additional pileup inside of demand deposit accounts, primarily checking accounts, is worth 20% of US GDP. If you have the number one economy in the world that has this kind of extra accumulation of cash happening inside of it, you got to sit down and take notice. Now, forecasters like Jay and I will look at a number like this and say, okay, so if all of this money comes into the economy all at once, what do I need to revise my US growth forecast up by? Now, we get excited about revising the US forecast up by 1% in any given year. But folks, if all of this money came in all at once, I would have to revise my US forecast up by 20%. That's right. Just let that sink in for a minute. This is a lot of years of mid-pandemic pent-up demand inside of regular checking accounts. Now, why do I believe that people are going to spend this? Why else would you keep money in a checking account, folks? You're intending on spending it. There's a lot of pent-up spending happening in the US economy, and this is one of the reasons there's a lot of inflation right now. It's not central banks printing money. It's not, it's partly that. But folks, you have to understand what has actually happened inside of this dynamic. You take a fully functioning economy, you shut it down by policy, people still earn their incomes, and this is what happens. And they're waiting to spend this on something, on housing, on consumer goods, on trips around the world, whatever we allow them to do. This is a phenomenal realization of the state of demand. Now, this didn't just happen in the US, it happened in Canada, it happened in Western Europe, it happened in emerging markets as well. The same phenomenon led to the pileup of cash that we actually see. Now, does anybody tell you that this is going on? No, they're saying, oh no, we're gonna fall into recession. Inflation is eating away at this. It will eat away at some of this, but the lion's share is still going to be there. And so I'm just waiting for the moment when, we actually see the evidence of this coming out of the economy as it happens right now. This is just being maintained inside of checking accounts. And so this remains pent-up demand to be seen in the economy when regular consumers figure it's safe enough to go out there and travel the world or spend on cruises or, whatever it is their heart's desire. So this is something that's still coming our way. What's the fourth thing? Supply chain disruptions. Jay spoke about this, and this, of course, is a concern to everybody around the table here. What actually happens in a situation like this? Well, as far as I'm concerned, the ability to create the supply is still there. It was there pre-pandemic. Nobody came along and destroyed it during the pandemic. There was no sort of destruction that happened there. It wasn't a natural catastrophe that got in the way of things. It was simply that we had to shut the economy down for a little while. So all the capital is still there. Why the supply chain disruptions? Well, COVID didn't decide to actually be uniform around the world, right? It hits one economy, there's a shutdown that happens, it hits another one a couple of months later, it shuts down and so forth. Well, what it's taken is a finely tuned instrument around the world, all of these logistical arrangements around the world, and severely discombobulated them by saying, okay, this one's not going to work now. Okay, it's back on, this one's off, and so on and so forth. That's not how supply chains work, as you and I both know. And so we're now about subsidizing, chip factories in the United States and Western Europe and goodness knows where else, and trying to do all kinds of gap-filling investments at the moment that I believe are going to add to our aggregate supply to the tune that in a couple of years' time, I'm wondering whether we're going to say to ourselves, oh boy, we actually got way more supply capacity to supply the economy than we need. And ultimately, what does that do to prices? Well, it takes them down as well. It takes a while for that to come into the system. But I think that's where we're headed right now, in the panic, where we're wrongly concluding that we don't have appropriate amounts of supply. We're making all of these adjustments. We're nearshoring, we're reshoring, and all that good stuff. But we've got to think to ourselves, okay, as long as we're not taking supply that existed before offline, are we actually net adding to aggregate supply out there? So they're hanging us up right now. They're causing inflation, but they're actually going to be quite an inflation remedy as we go forward. The final thing is, we had a protracted period of underinvestment in the economy. And that might sound like, okay, I'm arguing with myself now. I'm on the one hand, on the other hand. But understand that we got to 2019 and we were just at the point there, okay, we had enough capacity, but we only had enough capacity. Utilization rates were very, very high at that point in time. Now, if we still had pent-up demand in the economy, that's a problem, because you have just enough supply to be able to meet demand, but you've still got a lot of runway on growth and sustainable growth going forward. My illustration of the US housing market. So how did that come about? Well, the lack of GDP performance and people calling it a new normal following the global financial crisis caused a lot of underinvestment. Now, remember, we overinvested in the bubble years. Okay, so we had to use up some of that spare capacity, but we also did that for so long that all the newbies that were coming in and making investment decisions in their businesses and so forth thought, well, this is just the way the world operates. We can get by with underinvesting. You get to 2019, you realize, we've underinvested. And so what happens at a point in time like that? Well, you've got to change your investment behavior, not to a new normal that's higher, but to the old normal that was higher. That's just the way the economy actually works. So we have underinvested. We have only enough capacity to go forward. And I think all of these new investments that we're actually making right now are going to be more appropriate to the old style of investing that we actually did in the past. I hope I haven't confused you with that, but it's important to understand what the sources of inflation are, because we can't forecast going forward if we don't understand what they are. Now, the difficult thing with inflation, Jay, you remember when we talked about long and short run Phillips curves and so forth, and how it was that, we actually processed this. Let me just ask you a question. I'll take a little bit of a breather here, but can you actually believe that after 35 to 40 years of appropriate inflation management, all of a sudden, all the wheels seem to be coming off? One or two thoughts on that?
I know, and it's really worrying. I guess one of my questions is, here we've got a potential 20% growth in the economy. Are we aiming to use the blunt instrument of higher interest rates to chew up 20% of GDP? And Desjardins just came out with an analysis the other day saying that the only way that we're going to tame inflation is to induce a recession, which raises all sorts of problems about the way that we are actually trying to manage this problem. And
Mhm.
yeah, so back to your initial thoughts, Peter, about how we understand what's going on in a global economy here, and particularly in this kind of chaotic time. I'm sure not confident that we're approaching it in the right way. I guess the other thing I wanted to
Yeah.
say too is, and you're talking about some of these other the factors that that are behind inflation, and going back to the underinvestment problem, and of course that's also having a big impact on supply chain, uh, and to some extent the issue for many manufacturers, for many shippers, was, well, why would two things. Why would we invest to increase capacity when basically we're making all this profit? And maybe it's better to pay off or to pay dividends. Maybe it's better to acquire other companies to consolidate the market here, or maybe it's better to focus on high value and high profit products for a market where there's that much demand. And so we're seeing a lot of the trends that you were talking about in terms of the economy as a whole in manufacturing supply chains as well. And it is worrying because the investment, the capital that should have been going into expanding capacity, increasing production to keep up with that demand that was in the economy, uh, seems to be, the capital is being used for other
Mhm.
purposes there. So that that it and goes back to what you were saying to or telling us 2 or 3 years ago. We've got tremendous opportunity but we're not seeing that investment giving in the capacity for the entire manufacturing sector around the world to keep up with that demand. And that's very worrying as well. And without that investment, then you begin to, then you look at inflation, then you look at interest rates. Um, and as you say, much of that inflation was caused by government policies that were off kilter as well.
Well, you make a bunch of really good points in there, Jay. The thing that I think it boils down to on a policy side is this too much demand or not enough supply? And I
Right.
got into a debate with one of the Bay Street economists actually in a presentation downtown a couple of months ago, where he stood up and initially said, no, there's just too much demand out there and we've got to quell demand. That's the issue. And most policymakers agree with that. We're going to have to bring the big hammer of interest rates down to quell this demand because we simply have too much of it out there. And I couldn't disagree more. I believe this is a supply situation. And that's, of course, the case that I just made. We underinvested. We convinced everybody, to shed and to conserve cash and so forth, and to get rid of their labor and so on. And they created a big problem for themselves in terms of being able to come back. But those are all errors that were made on the supply side of things. Demand is just what it is. And, I weep, I guess, every time I hear somebody talking that way, because, interest rate policy, when you still have a fair amount of pent up demand in the economy, can actually take a good thing and undermine it. And of course, all policymakers would say, well, Peter, we're not trying to kill the economy. We're trying to engineer a soft landing. It's difficult to engineer that soft landing when it comes to investment, because as we all know, investments take years to, from shovel in the ground to realizing the capacity. It's not a quick fix. And so I'm concerned that the misread of that is really a problem. However, what we're faced with is something that we haven't seen for 35 or 40 years, and that's the psychology of inflation. And so what actually happens? Well, we have specific shortages. People say, there's no chips, so, we're not going to be able to make cars. Or, now oil is constrained. We've been on this carbon reduction thing, and all of a sudden, we've got wars or other supply chain disruptions that are actually compromising our ability to get a hold of what we need to run the economy now. Copper was having a particular problem at a particular point. We've got a question already about steel, where is that all going to go? We get these specific shortages happening inside of the system. And what does that do for us? Well, specific prices start to go up. So it's very targeted. And then central banks are coming out and saying, look, it's only oil. We're focusing on core. And so it's okay for a while there. We can deal with that. We've had to always deal with volatile food and energy prices before. But when the fast recovery happens, and now a broader range of goods are compromised by that through supply chains, it starts to become a bit more of a general condition. Then we start thinking to ourselves, is 2% actually going to be something we can count on or not? If this thing actually snowballs, we've got a big problem on our hands. And that's where economists get terrified, because if general expectations change, it's very, very difficult to get somebody's mind away from, a 6% mentality back to a 2% mentality. Now, how does that work in practical life? Well, are you resisting price increases that are getting passed on to you? Well, no. What are people saying? Well, if you want to actually get this thing, there's not much of it that's actually there. And I got somebody else that's willing to pay 15% more. So I'll give them all the stuff. And you say, well, look, I can't shut my business down. I'll pay the 15% more. And boom, all of a sudden your expectations around price increases have changed. Now, what's the more sinister thing that can happen when this starts to become a general condition? Well, businesses can't resist the opportunity to make a buck. The opportunism comes in and says, well, I'm not short of anything right now, but everybody's believing that there's shortages of everything. So let's just try this one out. We don't have to get out there and lie. We just have to say, well, the price of this has gone up 20%. And people go, oh, not them too. Okay, well, I guess I'm going to have to pay 20% more for this. And whether it's needed or not, it goes right to the bottom line of the company. And they go, ooh, glad we got away with that. But when everybody gets involved in this game, then it does become a general condition and all the profits are gone. It just becomes this crazy cycle now where it just goes through the continuum here and becomes entrenched in the economy. Can you believe how quickly, after 35 to 40 years of price discipline right around the world, how quickly we've actually switched gears here and come to this? Okay, so this is not an easy thing to fix. And that's why central banks have to bring the big stick out and say, okay, we got to break this thing. And the only way that we've ever figured out of breaking this thing is to increase those interest rates until people get that we mean business. And so there really is no ceiling on where they would drive interest rates to. If we don't stop increasing prices at these extraordinary rates, then they're just going to keep driving things up there right now. And that's the bad news. I think that even although we've been through this charade a number of times, central banks have not figured out how exactly you use a blunt tool like monetary policy and engineer a slowdown. We're quickly running out of time here. So I just wanted to talk about two different economies here, us in the United States. And here's our map of core CPI in the United States versus the regular, it's core CPI versus the 4-month moving average of growth in core CPI. And when the orange line is above the purple line, you have not quelled inflation. And so they still have their work cut out for them. Canada is even worse. Now, this is a little bit dated. I'm sorry about that. My up-to-date slide did not come through. It's not quite as dramatic as this, but it's still up there. Core inflation is continuing to drive, the monthly increases that we are seeing right now are continuing to drive expectations of year-over-year core inflation upward. Of course, that's the one that the central banks actually worry about. We're not through this thing yet. And so hang on to your hats. Now, it's important for me not to confuse you here. I've argued for pent-up demand. That's a global story, okay? It's a global story. It's not the Canada story. Our cycle has gotten out of sync with the United States. You need to understand that. It's pivotal to this presentation. So You recall the housing chart I showed for the United States. The dark or the light shaded purple bars were upside down here. They were underneath. We have actually a housing bubble that is going on. And folks, if we are going to wear this calculation of the housing bubble down here, we're going to see an awful crunch in housing starts. And it's going to take years at very low levels, around 130,000 housing starts. Now, understand, we're at about 230,000 right now plus. And so that's a massive, massive drop. And according to our calculations on demographic requirements here, we're not in good shape. If this is a leading indicator of all domestic Canadian activity, this is not a happy situation. I am not bullish on the Canadian economy for another reason, and that is our indebtedness situation, our consumer indebtedness situation is way out of whack. So in the United States, they were the worst in the world, and their debt to income ratio back in 2008 was 165%. The latest read on Canada is 185%. We are 20 percentage points higher than the United States was when they were the worst of debt management sinners at the personal level. Okay, so we have got a big bubble that I believe is going to burst on the domestic side. Now, what's the good news? The good news is if you're shipping outside of Canada with all of that pent up demand that is there, exporting is going to be red hot. And the weak domestic economy in Canada might well free up resources to deploy over to the export side of things to actually really lift our economy up. What I've just told you is, back to this 20-year cycle, the US, I believe, is still towards the end of the recovery phase of their cycle. So they've still got a lot of runway. Canada, not so much. We're at the tail end of ours right now in sort of that peak phase where you get the bubbles actually occurring. And that's what scares me about where we're at. I know that's not great news, but if you're going to have any kind of domestic recession inside of Canada, it's a good thing to know that you've got a backstop in the rest of the world. So even with interest rates increasing in the rest of the world, doing that in a context of pent-up demand, I think people can sort of afford 3 to 4% interest rates in a situation like that. Now, they'll go through an adjustment period, but it's going to be a lot lighter than the adjustment period that I predict for us here in Canada. Okay, so as we bring this to a close, I know that I have not gone through everything with you. I haven't given you my currency forecast. I haven't given you, the actual pinpoint of where interest rates are at. Let's cover that in Q&A. But what do we actually do with a story like this? How do we actually bring it together? So a quick summary. We have a stretched out cycle. US and Canada are at different points in the cycle. So that's key in terms of the strategic decisions that we make. The sources of growth globally are changing. That's not something that's immediate. That's been happening for quite some time. So this is really, the transformation from our traditional export customers out there to our non-traditional markets, the emerging, fast-growing emerging markets of the world. Those sources of growth globally are actually changing. Investment, badly needed right now, badly needed to compensate for labor shortages, for capital shortages inside of the economy, and badly needed because growth outside of our economy is so red hot. In places that we're not even doing business, that we need to invest to keep up from that. Growth is an elixir. When we can find the growth out there, even though we have soft spots that we have to deal with, the growth sources that we can find out there are an awesome opportunity for the transformation that I would argue was needed a long time ago, but it's never too late to actually keep up with that. Okay, strategy options as we go forward then. Well, we even in Canada here will have temporary pent-up demand because we socked up money inside of our demand deposit accounts as well. So all is not lost immediately, but that's only going to last for so long. We have very, very strong or very, very strong domestic weakness, if I can say that. We've got really a difficult situation there. We need to keep our eyes on the shifting sources of growth. And so I've written strategy papers that talk about China as a destination, India as a destination, and the Southeast Asian economies as a destination. Right now, it's sort of like Goldilocks. China's too hot politically. India's too cold in terms of its economic development. I'm actually looking more and more at Southeast Asian economies and saying, they're the right ones actually to deal with. And in fact, you can deal with the other two through Southeast Asia very effectively. Singapore not being the only place, Indonesia also a place that is a transit point for trade to India and trade to China. And so some keys to look at there. Investment and capacity, keep your eyes on this. This is really going to be so important for Canada going forward, and not just private investment, public investment in infrastructure as well. Finally, labor. Well, thank goodness we've got the kind of technology that we have right now, because labor is in short supply. And as Jay has already said, it's very, very difficult to change that overnight. Demographics do not change quickly. And immigration, I believe, is a false hope. It's a partial remedy for what it is that we need. We need to think about things differently. So number one, we still need to think about the labor supply that exists in labor-rich economies around the world, and figuring out how to leverage that to get the labor that we need, not bringing it over here, but using it there. Importing labor without moving it, I guess, is the way that I would put that. But also to look at tech solutions that displace labor. You might say, you're not allowed to say that out loud. Did you just say that? Did you just say displace labor? Well, unlike the first industrial revolution, this one is displacing labor that doesn't actually exist. We have such a paucity of labor right now that if you actually bring machines in to do things, it's because you don't have the people. You just can't get a hold of the people to do it. So it's almost the best situation to have the technology in. Now, you know, that's not exactly, that's partially just disingenuous of me, because it's not a perfect match. We can never do these kinds of things perfectly. Yes, there will be labor displacement, but because of the paucity of labor, we have the opportunity to retrain people quickly to do the things that are needed in the economy. We simply don't have enough people to do all the things that need to be done. Well, I'm hoping that some of that inspires a conversation, and that I haven't vacuumed up all of the Q&A time that we have for ourselves today. I'm going to pass it either back to Jay or Sean, whoever wants to take the microphone here at this point, and we can either discuss, or we can have a Q&A about all of the controversy that I've just dumped onto the table here.
No, that's great, Peter, and what a great overview of what's going on. You know, I think certainly living up to our expectations and your reputation of being controversial, but in so many ways asking the right questions here. So I've got a few questions, and then we can open it up to more general questions from the audience. Let me start with an observation, I guess, about the last point that you made about labor and displacing labor with automation. You know, that shouldn't be too surprising. The most automated companies, the most automated countries in the world, are also the ones with the slowest growing populations and the biggest labor problems here, or at least labor shortages. When you look at Europe, when you look even at China, Japan, South Korea, the link between demographics and automation is pretty clear. And when you look at, you know, the business of manufacturing writ large, there's been quite a bit of analysis out of MIT, of all places in the United States, is basically making the point that, you know, they're trying to say that the globalization hasn't displaced workforce in the manufacturing sector in the US as much as technology has. And but when you look at the kind of advanced manufacturing sector writ large, when you consider the jobs that are being created in the tech sector because of the solutions they're creating for manufacturing, what you actually see is, yeah, sure, there are fewer people working in manufacturing industries, but there are more people working to provide those high-tech solutions, and therefore the labor is actually counted, or the workers are actually counted in other sectors of the economy, in engineering and tech development and IT industries, for example. And if you look at, you know, total compensation in labor and manufacturing, and then include these other sectors in, not much has changed at all. To your point, anybody who says things are different this time, beware, especially if it's your financial advisor here, that it isn't that different. But I think what we're seeing and it is a question to you you like me, like looking at numbers here, but one of the big challenges I think economists have and policymakers and business strategists have is really trying to make sense of numbers and statistics that were defined probably according to an economy that worked 40 years ago and not necessarily reflective of a modern integrated economy where you do have this intersection, for instance, of technology and manufacturing. So, when we survey our members and ask, are you a manufacturer? Are you a technology company? Are you a services company? The answer we get is yes, because that's the reality of the business today.
Yeah.
So that makes it very difficult to do some pretty detailed analysis if we're working on old stats.
You know what's interesting about that, though? I got to jump in here, Jay, because the raw material that we work with is fundamental to coming up with the solutions. And this is often an argument that is raised. And yes, when it comes to official statistics, most of them have a 60-day lag. Which in a world like ours right now is just like, that's just like way too late to be able to react in real time. But at the same time, what we see happening is the generation of this data through online means, where we actually have lots of real-time information that says, okay, now we can develop an up-to-date, almost a daily proxy on how retail sales are going, because we've got satellite images of parking lot activity inside of a Walmart.
Right.
And these are very effective, actually. So I would say we're not there yet. We're still dealing with these old data, but companies that are really putting AI systems to effective use are finding these data series, those continuous time series. Jay, I think we're going to get to the point in the not too distant future where we have real-time daily GDP. I believe that's going to happen. And so you started off the presentation by saying, I remember in microeconomics, we assume perfect information. At the same time as things are chaotic, we're getting more real-time data series at the moment that I think that quietly, without anybody noticing it, the remedy for all of this chaos is let's have more data receptors out there and let's put them into a big data lake and let's be able to use them. Let's have little data bots swimming around inside of that data lake that are going to tell us what's actually going to happen. And I believe leading edge companies are doing this for themselves right now. They can't wait for the official agency to actually come up with things. Well, I think, once we get to a position like that, we're going to be able to make even way more instant monetary and fiscal policy decisions that I'm hoping are going to be far less disruptive to the economy. So I don't know if that's where you were going with your question, but I'm actually very excited about what I see happening from an economist / statistician point of view, because I believe that whereas we have always been in sort of way up in the ether of theory before, something revolutionary is happening to make economists very, very practical and very relevant to what's going on right now. And the high-tech companies are the ones that are actually leveraging this more than any other. Did you have another question for me, Jay, there?
Yeah, so and just kind of riffing off that, I think you're absolutely right. And in many cases, it's a question of how do you use that data, like data with a purpose here. Data is data, but how do you actually turn it into intelligence as well? But I think that's another issue that a lot of companies are struggling with as well. Maybe too much data and not enough thinking about how is that data going to be useful in driving value for the business. And that's an issue we hear about all the time too. I did want to ask you though, I mean, you've painted a great picture in terms of some of the risks around the Canadian economy and the potential, for instance, in the US, which frankly, is probably the biggest opportunity for many Canadian companies, given the integrated nature of the economy, of the supply chains that here between Canada and the United States, and sure, there are other global risks out there, but it's also very we've the trade data that we've seen over the last 2 or 3 years show how important that U.S. market is for Canadian exporters, or for Canadian companies that are linked into those to the North American supply chain. But it's also there were big expectations that particularly built up over the last 3 years, that all of this COVID, all the supply chain risks, were going to lead to a massive reshoring of manufacturing back to the United States and back to Canada. And if anything, what we've seen, well, we haven't actually seen a lot in terms of the changes in where manufacturers are sourcing their products at all. But what we have seen is that Canadian economy, the manufacturing economy in Canada, has actually become even more dependent on imports, for instance, from China. So I'd like to get your perspective on this idea that globalization is at an end, and we're all going to become, at least regional, and but much more localized in terms of our supply chain connections.
Mm-hmm. The thing about investment that we all know is that you can't fix it overnight. So if you decide you're going to reshore, you're going to nearshore, you're going to localize, you can make a decision in 2021, and maybe by 2024, 2025, you're going to have things, up and running at 100%. So when the economy comes back, and when it comes back as quickly as it did this time around, what's your default? Well, your default is what you have now.
Yeah. And
that's exactly what we saw when SARS-1 happened. Everybody was saying, I don't want to get on an elevator with anybody anymore. I'm never going to, sit on an airplane with anybody. I'm not going to work shoulder to shoulder with somebody. And, a couple of months after the thing was sort of over, it was like, can you remember the crazy things that we were saying during SARS? And one of those, of course, was supply chains. And then the Japanese tsunami happened, and we said it all over again. And a couple of other things happened, and we said, we really need to do that thing. And when we've really had a bone-shaking experience, you would think that we would actually, after 2 or 3 of these things, say, okay, we keep saying we're going to do this thing. My question is, yes, when we say we're going to do these things, we really mean it. Why is it that we change our minds? Well, it's just so efficient the way that we set it up before. And once things get back to some semblance of normalcy, we realize that we really had our smarts when we designed all of this, and we've got to take a chance. We default initially to what exists, and then we price out what it takes to create the new, and we go, well, I'm okay to do this if everybody's going to do it at the same time, because my costs are going to rise by 10 or 15 or 20 or 30%, whatever. So I don't know that I'm going to have a business model. And so between the costing side of things and the sheer laziness of just defaulting to what you have right now, I think for the most part, we end up just doing things the way that we were doing them before. We're more serious this time because we were more traumatized. But I don't have a lot of faith in the longevity of our memories once things actually get up and running again and become normalized. Now, is it a problem? I don't know. It all depends really how the geopolitics of the situation shake out. And so the one thing that really has put a wrench into the spokes of defaulting back to normal is the conflict in Russia and ruminations about a conflict between China and Taiwan. And so if those are the case, and we really have to sort of cut and paste from the Russia situation where we say, okay, sanctions, cut, paste, put sanctions over to China, that's a whole different series of considerations. Can we actually do that, without bringing Walmart to its knees, for example, and so, easily said, not so easily done. And I wonder if, sort of our geopolitics is very related to the acrimony that we all encountered at the onset of the pandemic. It's your fault. It's the fault over here. Okay, we've got to, take the opportunity, build walls around our economies because we can't trust the phytosanitary conditions of country X or Y or Z, and then there's the cynicism about that. Are you just doing that because you always wanted to be protectionist, but now you've got a good excuse to be, that everybody's going to swallow? And so there's this tit versus tat that actually happens. It's very unnerving for the economy and very, very deleterious, I guess, to growth, to use $1 million word. And so does an economy, does a rising tide lift all boats in a situation like this? Do we actually get over our protectionism when our job becomes, okay, let's just get the economy back up and running again? That's a whole other PhD thesis, because, there's some who don't actually want to get the economy growing again. And those are the ones that I find actually quite scary, because growth is in our DNA. Growth is something that from birth is so fundamental to us as humans that any talk of why do we need to grow really, really scares me, because I can't take something like that at face value. Anyway, that would lead to a whole other discussion. The point here is, I do think that it will be increasingly safe and expedient to use what exists. So it doesn't surprise me that the Canadian trade numbers are as they are, that we are defaulting back to our sources of supply and maybe overdoing it a bit because of this puff of demand that we have right now, this desire to spend when we couldn't spend during the pandemic. I know that was a lengthy answer, but not an easy question.
No, I think it's really very, very accurate answer too. And if there is an opportunity to localize production, attract investment, product mandates into Canada and into North America, it's probably going to come in more innovative sectors that are setting up businesses rather than trying to restructure existing supply chains. And the one big issue here is the geopolitical impact. And clearly, the war in Ukraine is a big problem, but growing trade tensions with China and geopolitical tensions with China too can't help to be a major consideration going forward. So Peter, let me, I think we've got a couple of questions, and maybe Sean, do you want to help us out here in terms of fielding questions from the audience, and let's turn over to our guests.
Sounds good. So I'm just going to read them here and leave you both spotlighted. So by the way, if you are still here, it looks like most everybody has stuck around. Make sure you use the Q&A box to type your question and we will read it out. So the first question comes in from Rosamalia. She asks, and this was during your session, Peter, how do you foresee commodities, products, specifically steel, in this global chaotic environment?
Well, it's a great question, Rosamalia. This has really become a situation where we've had to look at commodities on a commodity by commodity basis. What is its supply chain actually doing? Where are the sources of demand in the rest of the world? And how are we actually to fix ourselves inside of this market? Well, I go straight to the places, the uses, I guess, of this. In an environment where interest rates are increasing, typically you would look at housing, you would look at particularly multiple units that need structural steel for them. You would look at commercial building as well. You look at the auto sector, a lot of intensive steel need there, and of course, machinery and equipment. And so in terms of these needs, boy, it all depends which part of the world you're actually looking at. We've got this property implosion that's happening in China. And every day there seem to be new videos out on YouTube there about whole apartment blocks that were never occupied, just being blown up, demolished. And so it's been one of the key sources of demand for steel around the world. And China, of course, tried to supply as much of that as it could. Internally, China turned itself around from becoming a low quality producer that had to import a lot of steel in the early 2000s. It flipped around to a place that was exporting huge quantities, drowning the market in high quality steel because they were creating state-of-the-art plants to actually do this whole thing. So I'm looking at China's own need for steel and its capacity to supply the rest of the world and saying, we could be in a glut situation. Now, maybe not right away, because we've got enormous pent-up demand for vehicles in the North American economy and the Western European economy. The chip shortage has created very, very long lineups for new vehicles, and of course, price increases to go with them. And so it'll be very interesting to see that once these log jams are cleared and there is a flow that's actually occurring there, what it's going to do to the demand for steel. So I think things are going to get hot before they cool down again. And then when they cool down, they're going to cool down in a big way. So maybe as much as 2 years of runway for steel being, supply constrained and higher cost, and then seeing that run off and steel being quite a bargain at that point in time. So that's sort of how I'm seeing it at this point in time. I hope the answer to that question is useful to you. Back to you, Sean.
Thanks, Peter. So Rosamalia had a second question, and this might be interesting for both of you to answer. It said, how would you suggest to the government to manage the Canadian current inflation?
I could be a mean guy and say, okay, Jay, you handle this one, but let me take a shot at this, and then you can disagree with everything I say. One of the things that we observe, and I'll keep it close to the Canadian economy, but it's not unique to us, is that fiscal policy and monetary policy can often be in conflict with each other. So, clearly governments are concerned about affordability of goods and services right now. And so taken on its own, one of the remedies for that, if you didn't really know what the sources of inflation were or what have you, how could we get more money into people's pockets? Well, if you've got a supply constraint out there and you say, okay, well, I'm going to give people more money. Well, there's just more money chasing the same fixed amount of goods and services that are on the shelf. So what happens there? Pure price increase. So you're actually feeding inflation with fiscal policy at the same time as the Bank of Canada is crimping down on the economy with higher interest rates, and you find things actually battling each other. Now, I'm not going to wade into the politics of today, but there is some of that is going on in policy announcements. I go back to the late 1980s when John Crow, the governor of the Bank of Canada, and David Peterson, the premier of Ontario, were dueling it out with each other, because at the peak of the cycle, the Peterson government was dumping money into the economy, creating all kinds of Class A office towers in downtown Toronto. And together with the mayor of Toronto at the time, there was all these permits that were being approved, and the bubble was just being fed. And John Crow had a famous meeting with David Peterson where he said, I don't think you're going to win this game. So let's talk with each other about how can we tone this down? How can we take some of the heat out of the economy? And they didn't agree. And so interest rates went up, and, a massive recession actually occurred, and all kinds of drama around all of that. But a classic case where you're actually trying to get inflation down, and even government can't agree on a coordinated policy to do that. So that's always a danger. And it's important for fiscal and monetary authorities to be talking to each other so that they're on the same page, so that they're not fighting each other, and so they agree on policy. Now, we've had a lot of stimulus in the economy over the pandemic period. Very hard to actually say, okay, that time is over. It's hard for, a government of any stripe to do that, because the danger is, when we pull the stimulus rug out from under people's feet, it could be painful. And, the news is going to show, the vignettes of particular people who are suffering as a result of all of this, and everybody's going to extrapolate that to the entire economy. Well, the truth of the matter is, with a low unemployment rate, you shouldn't need to be stimulating. You can pull all of that stimulus out and free up resources to the hot running sectors of the economy, and actually aid monetary authorities by toning down that fiscal stimulus. So if you're tempted to actually keep it there, you're working at cross purposes. So, the big thing here really is intelligent, coordinated policy. And thankfully, you've got a hot economy that can just continue to run. It's the best of conditions for actually either tightening monetary policy or withdrawing fiscal policy. Now, I hope I haven't stirred up too much controversy. Jay, over to you to disagree with everything I've said.
No, I think that's true, and I guess I see another part of this problem too, in terms of the disconnect between government policy and monetary policy, which is regulatory policy. Here we've got for a number of years regulatory changes that made it easier and easier and easier for people to get mortgages, to buy houses, and that was a part of the particularly a couple of years ago, a part of what CMHC was trying to do, provide more support for young families to buy homes. And now, of course, many people working in or taking out lines of credit, mortgages that they're going to find it very difficult to afford when interest rates go up. I think the other area that we see in terms of regulatory policy where that is so discouraging are the problems that many manufacturers are seeing, and particularly companies that have, over the course of the pandemic have focused on new therapeutics and medical devices, on PPE in Canada, and really struggling to get that onto the Canadian market. In many cases, it's because either we don't have standard product standards or regulations or regulatory approval processes that will enable them to do that. So part of the supply constraint in Canada is because of regulatory problems that we're seeing. And of course, and I don't want to get into the issue about competition policy either, but we really do need, as you say, Peter, to align fiscal and I would say regulatory policies with, and maybe taking and clearly taking a longer term view in this, and in the context of this pent-up demand, but a longer term view about what the potential impact could be on inflation. And I don't see, for many reasons, the focus is on urgent short-term situation, or has been over the past several years, rather than thinking about what the longer term consequences or how to unravel these policy changes.
No, absolutely. I think that puts us pretty much on the same page. Sean, back to you.
Yeah, so there was one final question here, and I'm thinking this is more for you, Peter, but I guess it's your call. What could you foresee for the Canadian mutual funds market? This might be a desire to more look at personal investment strategies, but going back to your earlier point, maybe this would be helpful to some folks. So I'll leave that one.
Well, I'd like to hear this as well, because I'll just be taking notes here, Peter.
Well, this is where I should, end the session just by going through my very lengthy disclaimer here. I'm not in the business of giving investment advice, and I want to be entirely clear that you should talk to your investment advisor about questions like this. I can offer an opinion that you can put into the mix, but in no way, would I be liable for any of the things that I would say in terms of whether they work out or not. Generally speaking, when you look at my presentation, you know that I'm not bullish on the domestic economy inside of Canada. So those things that are very domestically oriented, I would say, would be in a higher risk bucket. Now, of those things, there are some things that are staples, okay? So grocery stores and food supply chains and so forth are the kinds of things that you still need to actually have. And for the moment, until we get to a carbon-free economy, gasoline is one of those things as well. So when you look at the hierarchy of, let's say, needs inside of consumer spending and so forth, well, keep an eye on those things, when you're actually picking and choosing. If you have to be in Canadian equities, then that's what you need to look at. in an interest rate increase environment, as interest rates are going up, of course, that's actually depreciating the value of bonds, because the price of the bond, as we all know, is inversely related to the actual coupon rate on that bond. So, it's a bear market for bonds for a while. So, I'm trying to say, okay, when it's between fixed income and when it's between equities that we're actually looking at, that's sort of the paradigm that we're in. What I am personally far more interested right now in is Canadian companies whose primary obsession, whose primary bottom line is really coming from the export side of things. And it's a risk, because my presupposition there is outside Canada strong, inside Canada weak. And so when you're actually picking and choosing, the ones I'm more interested in are either Canadian companies with a significant domestic presence that are in the middle of an international push, because it won't be realized in their stock price yet, or ones that are actually out there and they are succeeding and they continue to have expansion plans, particularly in fast-growing markets of the world. So it involves doing due diligence. What is the company's strategy? Where are they actually looking for things? They may not agree with me in terms of, where the growth is going to be stronger, where it's going to be weaker. That doesn't matter. If they've already got a footprint there, then you know that the growth is going to take care of itself, if indeed what I'm saying about the world economy is ultimately what transpires in the next 1 to 5 years. I hope that helps.
Great. Thanks, Peter. So that's it for questions. Jay, I'll turn it over to you.
Yeah, I've got one zinger for you, Peter, and I'm expecting a really straight answer. We've got this pent-up demand, lots of potential, lots of cash here sitting on in checking accounts, personal, but I think you take a look at profit margins in a lot of industries too. There's a lot of cash. Inflation's eating into that, and even in manufacturing, the selling prices are up, but they're not up nearly as much as input prices in manufacturing. So inflation's eating in general into cash flow. Then we're into a world of higher interest rates. Not only in Canada, but in the US, Western Europe, around the world, here too. Higher interest charges. Interest charges are also eating up cash. Higher interest rate, one way to get rid of all that pent-up demand is to take the cash that's available and pay off higher interest rates and higher debt charges. I guess from the point of view of a manufacturing company, where the real issue is, how do we invest? And as you were saying, how do we incent more investment to be able to increase supply? My question is, what is more dangerous to the economy, long-term health of the economy? Higher interest rates or inflation?
A great question. I'm going to answer it in this way. I don't think inflation is ultimately the problem. And I know that, that makes me sound like a cold-hearted capitalist, only interested in business kind of person here. That's not what I mean by that. I know that the pain that's being inflicted on regular people right now is widespread and it's hard. The reason I say that inflation is not ultimately the problem is central banks know what to do about inflation. So inflation is going to go away. They're very determined to do this. They've demonstrated that with some of the most aggressive interest rate increases that we have seen ever in history. And so inflation is going to go away. I think the bigger problem is the medicine, our reaction to the medicine of actually taking inflation down. So inflation goes, okay, what's left? And, did you drop a nuclear bomb on it that, has sort of taken everything out and literally there's nothing left. That's what central banks try assiduously to avoid, and it's very, very difficult for them to figure out, okay, how much is enough. And we've at least got 2 episodes of this in our own memories and existing memories of this actually occurring. I think the impact of interest rates, I'm going to go right back to my presentation because I think it answers it, although I didn't say it this way initially. Really, the impact of interest rates on an economy depends on the preconditions. We got a bubble. Interest rates are going to they're going to wreak havoc with our domestic economy. And I don't think there's really any way of getting out of that. Now, that's what's going to bring inflation down. And our next problem is going to be, okay, does it bring in disinflation? Does it bring in deflation? That's really what we're going to be asking ourselves. If we get to a point where we're so successful with this that prices actually start to drop, I wouldn't actually be overly concerned about prices dropping, as long as they only dropped to the trend 2% curve that they were rising by in the first place. And then we get back to 2%. That's a full restoration of the actual price level. But that's going to take a while, and we will have repeated monthly declines in the consumer price index until we get to that point. Enough of them that people will say, this looks like a new normal. Now we've got deflation. Now we're Japan. We don't know what to do with this. There are no remedies for this. And so what I think we will actually see is that we have a permanent increase in the price level. We get ourselves back to 2% growth, but from a much higher level, and we continue on with that. And just by virtue of having done that, we have permanently reduced the net wealth position of consumers inside of our economy. And Canada won't be the only place that does that. The question is, the faster you actually get to 2%, the less the damage. And that's what makes all of this so tricky, because just getting ourselves down to 2% is a tricky thing to do. We always overdo it. And if we create a bad recession, the probability of actually having either bad disinflation or worse, deflation is what we need to watch out for. And so, and we don't have a playbook for that, frankly. Central banks have not figured out how to do the disinflation or deflation thing. They have a playbook for inflation. It works very well, not so much for the other guys. So that would be my concern, that we actually turn this thing around so much that we create deflation. We don't know how to actually get out of that situation. I don't believe that's going to happen. Central banks are very sophisticated, and I believe that they would act very instantly to say, okay, now we're at 2%. Okay, everybody got that? 2%? Okay, let's think 2%. Okay, it's 2% now. Okay, phew, glad that episode is over. Okay, let's all do 2%. And, after the price increases that we've seen in the psychology and the cycle of that and so forth, I think they'll be reasonably successful in bringing that about. And
I guess the biggest risk is that bubble that you see in the Canadian economy right now too.
That's right. Us in Australia are perhaps the places that really uniquely have that, just because of the way our cycles got out of sync with the rest of the world for different reasons. But we both seem to be in that paradigm. But I would say most of the rest of the OECD is where I characterize the world as being, and that's why we can count on the export growth that we have. Sorry, I just tacked that on to the end there. Just wanted people to be clear about where I stood on that issue. Sorry, back to you, Jay.
Yeah, no, that's super. Listen, Peter, thank you very much. Provocative, insightful, exactly why we like to have you with us right now and always. So looking forward to the next outlook, and maybe in a few months' time, and I hope it's a little rosier for the Canadian economy, but clearly I think you've hit the nail on the head in terms of the opportunities that exist globally. So, well,
I would like nothing better than for it to be rosy for the Canadian economy, if I could just editorialize. Anyway, sorry.
Yeah, no, exactly. But thank you very much for joining us.
My pleasure.
And to all of our guests as well.
All right. Thank you. Thanks for joining us today, folks.
Thanks, everybody. So that concludes today's presentation. Appreciate you joining us. Thanks again to Salesforce for supporting us. And as always, here at NGen, you can always visit their website for more information on whether Salesforce is the right solution for you. Thanks, Peter, for joining us. Always, as Jay mentioned, insightful. Thank you, Jason. And thank you to everybody for joining us here today. Recording will be sent soon. Have a great day.